the Economy Creators live weekly broadcast training, broadcasting to you live via Facebook, YouTube, and the Economy Creators website, www.theeconomycreators.com. So let's go ahead and get started. As you see, this is going to be about trading supply and demand. As you see from this graph here, if you can read what it's pretty much trying to tell you, is that when supply is high, demand's low, and when demand's low, supply is high. I'm going to break all that down for you as we go along further now in this video. All right. So when it comes to trading supply and demand, one of the first things you need to understand is what the heck is supply and demand? What is it? So what is supply and demand? Well, supply and demand is simply the amount of a commodity, product, or service available and the desire of buyers for it, considered as factors regulating its price. So for an example, a quote that could be said is, by the law of supply and demand, the cost of healthcare will plummet. So when trading supply and demand, you want to understand both the concepts of the law of supply and the law of demand and the law of supply and demand. So let's first look at the law of supply. The law of supply is the microeconomic law that states that all other factors being equal, as the price of a good or service increases, the quantity of goods or services that suppliers offer will increase, and vice versa. The law of supply says that as the price of an item goes up, suppliers will attempt to maximize their profits by increasing the quantity offered for sale. Here in this chart, you have the supply curve, okay? Now, what is the law of demand? The law of demand states that quantity purchased varies inversely with price. In other words, what that means is the higher the price, the lower the quantity demanded. The reason for this phenomenon is that consumers' opportunity cost increases. So they must give something else up or switch to a substitute product. And here on this slide, you have a chart of the demand curve. So now we look at the law of supply and the law of demand. So now we have to combine those and figure out what is the law of supply and demand. So the law of supply and demand is a theory that explains the interaction between the supply of a resource and the demand for that resource. The theory defines the effect that the availability of a product and the desire or demand for that product has on its price. Generally, low supply and high demand means an increase in price. In contrast, the greater the supply and the lower the demand, the price tends to fall. So as I was saying before, when I realized that I was not unmuted and nobody could hear me, was that, excuse me, let's look at some examples of the law of supply and demand. What's a big popular brand out there right now? Nike. What's a big popular brand branded by Nike within Nike? Jordan. Got your attention now, don't I? So, especially if you're parents out there and your kids love Jordan gym shoes. Jordan gym shoes are very expensive, are they not? Yeah, they are. Now, some years back, I used to actually work for Nike, and I was made aware of the limited supply made per Jordan style that's get released. It's not the same exact number for each style release. It's different depending on the shoe that's being released, which retro Jordan it is, the popularity it has in the past, as far as for how many will be released. So the supply is so low on Jordans, but the demand is so high, so they charge so much. Again, if it's the supply is low and the demand is high, the price will increase. Now, opposite of that, let's look at Payless Shoe Store. I'm not hating on Payless. If anybody shops at Payless, whatever floats your boat, got good shoes for the kids. They grow all the time. I get it. But shop at Payless, right? Payless, name in itself, pay less, right? Okay, so with that being said, the supply at Payless is plentiful. It's plentiful. Payless is everywhere. Payless is everywhere. And they got a whole bunch of the same shoes. And in one store, and the next store, and the store down the street, and the store up the block, the store in the next city, the store in the next state, so on and so forth. So The demand is not high for Payless shoes. Nobody's in line the way they are for Jordans to get Payless shoes. Nobody's like on Nike.com or Payless.com trying to use codes or whatnot. Got all their friends on with them trying to get in line and get the shoes when they release because they're going to be gone within like 10 minutes. Payless doesn't have that kind of a demand, so they can't drive their prices up. Their supply is too high and their demand is not high. So their prices has to stay low. Their prices don't fall, they just stay low. It's like I told somebody the other day, if you think about it like milk, whoever has kids here or babies, you know, your kids have formula or milk or whatever, right? So if there's only one cow left in the entire world and I own that cow, I'm the only owner of milk pretty much. There are no goats. Let's take all the goats out too. Can anybody say, oh, I can get a goat? No, you can't get a goat. I own the only cow. I own the only goat. But you need milk. The supply is low, my friend, but the demand is high. Y'all got babies. But because I have the only cow and goat in the world, I'm charging $5,000 a gallon minimum. Because I can do that. Because I have the supply and you have the demand. Now, this is not the case because the world is full of cows. So at our local grocery stores, we pay what? $2, $3 per gallon of milk. It's because the supply is there. Thus, they cannot raise the prices. Simple law of supply and demand. Low supply and high demand, price will increase. In contrast, the greater the supply and the lower the demand, price will tend to fall. Let's move along because now we need to figure out what does all that mean in terms of trading. You all are Forex traders, commodities traders, futures, options, stocks, what have you. What does it all mean when it comes to trading? Simply, when price is high, sell. Sell high. And when price is low, buy. Buy low. Our world is built upon this economic principle of supply and demand. Simply sell high and buy low. We were founded upon this. Everything that we do, everything that we buy in life, all of our consumerism is based off of supply and demand. And so this is the general basis behind everything in life, business-wise and financial-wise. Why aren't you trading like this? You should be trading like this. You need to have this in your arsenal. Whatever your strategy is, you need to be incorporating supply and demand, because if you are not, you are missing a lot of pips. You're missing some good entries. You're missing plotted moves to be able to say, hey, I know once price get up to his 1.73894 or whatever, it's getting ready to drop. You only know that if you know supply and demand. All right. So let's look at some examples. So here's the chart legend. Simply put, you're going to see on this next few slides, you're going to see the euro pound broken down from the monthly all the way down to the 15-minute. And you're going to see the zones plotted out for each of those time frames. On these zones, the red box that you will see is an untested supply zone. The dark green box you will see is a retested supply zone. And the blue zone, untested demand. And gray zone is going to be a retested demand zone. So let's go ahead and look at these examples. So here you have the euro pound on the monthly. You see the big green box at the top. That is a retested supply zone, which means price fell from that area, from that zone, came back up and retested it at least 2 times. As you see, price went up to that box quite a few times, okay? But that is a retested demand zone. What a retested zone means is that once price comes back up to it, you want to watch it, because it's not as probable to bounce from that zone and retreat from it back where it came from, aka to sell once it re-hits this. Most likely is going to play around with it and try to break through it, because this zone has already been retested. It's already been moved. It's already been worked off of. It's already been used for its financial gaining power. And I'm going to get to what I mean by that in a bit. Okay. But that is a supply zone. Right below that, you have a demand zone there. That demand zone, as you see, has not yet been retested. It looks like you have a few candles sitting there in there, and it continued to buy up and has not yet been retested. Price right now is right below the supply zone that's been retested, and chances are it will go down and retest the demand zone and then continue to buy back up. But this is an idea to give you to show you how you want to be looking at your supply and demand zones and what it looks like on a chart. Because people always tend to confuse supply and demand zones with support and resistance. Support and resistance, guys, are lines. It's pretty much just like it's the best way to explain it. I guess simply put it, it's serious. It's their lines. Whereas a support, supply, and demand are zones. As you see that green supply retested zone, you see how big that zone is. A supply or a resistance line is not that thick. It's not a box. It's a line. Whereas supply and demand are zones. They can be 100 pips plus deep, depending on the candle that created the zone. That's why they differ severely from support and resistance. Never confuse the two of these. They're not the same at all. That's one thing that I wanted to identify in this training is that supply and demand are not support and resistance. All right, move along, next chart. All right, here you have the euro pound on the weekly. Here you have an example of where you see some retested demand zones there, which would pretty much tell you that when price falls, continues to fall from that supply zone that was created, what will end up happening is going to blow through that demand zone, that small demand zone that was created there that has been semi-retested with that wick that you see, that last candle printed. It's going to head down towards that last demand zone you see because that's the one that has yet to be retested. Now, will new demand zones get formed as price begins to fall? Possibly. But right now, based off of what we see the current zones are, we know where price is headed. We know that on a downtrend, this price is headed down to that demand zone, to that 0.70450. Okay? Next example. Here you have another example here of the euro pound on the daily. You have a good supply zone up top that has yet to be retested. You have a supply zone in the middle there that has been retested several times. Below that, you have an insignificant supply zone, in my opinion, and you have two demand zones, one retested, one untested. Price is currently buying up from that untested demand zone. Price is currently trying to trade through that retested supply zone. Supply zone. What this is telling me that right now is that based off of where price is coming from, it's going to chase that supply zone up top. Now, I know the demand zone that it recently came from has already been retested, but price is still showing bullish power. And it's breaking through that miniature supply zone that you see, that small green area, that dot almost. The supply zone above it retested multiple times. Most likely, like I said, this means price is headed up toward that supply zone. Now, another example on the euro pound on the 4 hour. So here you have a lot of demand zones and you have a small supply zone up top that's been retested. With all these demand zones kind of confirming that it's probably a euro pound is on an uptrend right now, most likely, from what these charts are showing me. And based on what this demand zone, that's where it's rising. Price is on a rise right now. And as you see that retested supply zone, price is probably likely going to buy through that. Remember on the daily time frame, we just saw that there is a supply zone above this area that price is headed towards. The demand zone prices come from on this 4 hour chart, prices already retraced and created a little bit of market structure, signifying that it's not going to come back and retest that demand zone right now, but continue headed upwards to retest that supply zone that we saw on the daily time frame. Now, here you have your euro pound on the hour. Once again, you have a retested supply zone, you have an untested demand zone, and a retested demand zone. Right now, prices has already fallen from the supply zone, created a demand zone, bought back up into the supply area, giving it a retest, did a small bit of retracement, has a small bit of consolidation occurring right now. simply telling me that right now price could do one or two things on this from this standpoint. Retrace a little bit back and retest that demand zone. That demand zone is formed from a single candle, not a base. And I'm going to get into that in the next few slides. So there's a chance we may see a bit more retracement before we see the continuation of the move up. Okay. And last but not least, here you have on your 15-minute chart, you have your retested supply, untested supply, several untested demand zones, and a retested demand zone. Price right now is currently buying up from demand. Now, price right now is currently printing a bearish candle per when these slides were created, which was last week, Friday, so about a week ago. And this is the 15-minute chart. So this is an old picture compared to where price is currently at right now. Feel free to look at your charts right now and see where price currently is. But per the training itself, where price is currently at right now is coming down to retest that miniature demand zone that was created. After it does that, to go and buy up and go through that supply zone that you see. Why go through it as opposed to bounce off of it? Simply because on that supply zone, even though it seems as if it hasn't been retested, if you look to the left, there is a very long wick that is tipping it, like within 1 pipette of the supply zone. That's a semi-retest, not really a retest, but that supply zone isn't coming from a base either, which is also a good indication that price is going to move up after it retests that little demand zone that is headed towards right now. Now, we've seen some examples. Let's get into the details, aka the meat and potatoes. Drawing supply and demand zones is a skill many people fail to master correctly. Sad, but true. Why? Because most people don't know how to spot these zones. Yes, you can clearly see where prices like made a move up, made a move down. But are you clearly spotting out the actual zones where these moves are occurring from? So what we're going to do right now, I'm going to show you how to look and spot these zones. So that way, next time when you pull up your chart, you're able to easily point out where you see supply, where you see demand. We're going to start out first with supply zones. All right, so supply zones. Supply zones simply can be found by locating a quick drop away from a single candle or by locating a big drop from consolidation, aka a base, which is simply a structure that consists of about 7 candlesticks, depending on the time frame you're looking at, in a box sideways range, typically known as consolidation. So again, you find a supply zone by looking for a quick drop from a single candle, or you look by locating a big drop from a consolidation or a base. And that's how you will find a supply zone. Let's look at an example. So here you have a supply zone formed from a single candlestick. Look at the top of the chart. Look at the red supply zone. Where do you see a base? You don't, because there is no base. It's a single candlestick formation zone. There is no base to the left. There is no sideways trading or range of candlesticks. Not 3, not 5, not even the 7 that we prefer to see for a strong base. We don't see any of that. We see a single bearish candle that drops, creating that supply zone. Now let's look at one formed from a base. So here you have a supply zone formed from a base, or aka consolidation. So at the top of the screen, at the top of the chart, you have 2 supply zones. Either or, does not matter. But let's look at the second one. If you look at the second one, before that big bearish candle that drops from it, to the left of that, you see 1, 2, 3, 4, 5, 6, 7, like 7 or 8 candles, for the most part, what are like dojis, all trading in a sideways range, aka consolidation, aka the base. So this is a supply zone formed from a base. Now, inversely, you would look at it the opposite direction for demand zones. So how do you find the demand zone? You do the opposite of what you did to find the supply zone. You locate the demand zone by looking for a large move up from a single candle or by locating a big jump up from consolidation, aka again that base, about 7 candlesticks in that box sideways range. Some examples. Here's euro pound an hour, and we see we have a demand zone formed from a single candlestick. As you see, the blue demand untested zone right there. There is no consolidation to the left. There are no candles stacked sideways. There's just a long wick and then a bullish candle that creates that zone, aka a demand zone formed from a single candlestick. Now let's check out one formed from a base. Here you have a demand zone formed from the base. Look all the way at the bottom, that bottom demand zone. If you look to the left of it, you see some candles there, right? If you count them, it's about roughly about 10 candles, all trading in a sideways range, consolidation, aka the base. And what happens? Price buys up from that. So this will be a demand zone formed from a base. Now, so what's the science to these zones? Is there something as a stronger demand zone or a stronger demand supply zone compared to another one, or what? Like, what's the deal? So here's the deal. Zones with a base are more successful than zones formed from a single candle. Simply put, if you're going to trade supply and demand and you trade from a base, you're going to be more successful and more happy than the supply and demand trader who trades from a single candlestick, because they're going to be less successful and they're going to be actually angry. And here's the reason why. There is no strength test in zones. I don't care if it comes from a single candlestick or from a base. A supply zone, a demand zone, is just that, a supply zone or a demand zone. They're both equally valid. They're both equally strong, I guess, if you want to use that word. Where the difference comes in, there's the question. Why are zones formed from a base more successful? There's a psychology literally behind supply and demand, guys. There's literally a psychology behind this. This next slide I'm going to show you, you can actually go to www.forexmentoronline.com. I give credit where credit is due. I took this insertion from his article on that site, right? But here's the psychology. Typically, supply or demand zones, which are formed from a base, tend to result in more successful trades than zones which are formed from a single candle. Why is that? Well, this is due to the sensitive nature of the psychology of the traders who were in a trading position back when the base was being created. When the market swiftly moves up or down in the case of supply and demand zones, it negatively affects the psychology of the traders who had trades placed in the base before the market made that move up or down. So a zone formed from a single candle means not a lot of traders were caught on the wrong side of the market before the market moved up or down, creating that supply or demand. However, a zone with a base contains far more trapped traders because the market was moving sideways in consolidation before it began advancing higher or falling lower. Thus, when the market returns to a zone formed from a base, the traders who are trapped, either long or short, depending on the zones, will begin closing their trades. Now, I'm going to stop here and ask, does anybody know why this is? Don't worry, I'm going to tell you. So when the market returns to the zone formed from a base, the traders who were trapped, either long or short, depending on the zone, will begin closing their trades. Why? Think about yourself. When you're in a trade that you say, oh, okay, I know that's euro pound, I know euro pound about to buy up. I know it's about to buy. It's about to be a buy. And you enter that buy. And then it goes opposite. And I mean, say, for example, your account is a $500 account and you're negative like $400 or $420. The only thing you're thinking at that point in time is, I don't want to blow my account. I know I'm pretty much right on this euro pound, but I need to close, but if I close, I'm gonna have like $80 left. I have 500 in this account. So my thought is, what do I want? I want to break even. I just want to get out of this trade and not lose any money. I don't care about making money right now. I don't care. I don't care about making money right now. Just let me keep my $500. That's the psychology. So again, when the market returns to its zone formed from a base, the traders who were trapped either long or short, depending on the zones, will begin closing their trades because their first thought at that point is to break even. So with them closing their trades, coupled with the additional buying or selling of other traders trading the up or down move into the zone, creates liquidity in the market. Now, this liquidity, okay, allows the bank traders to sneak their trades into the market without you noticing, which is why the market always moves out of a supplier demand zone when it returns. So again, hear that part, snapshot this, or something like that. Again, those traders who were trapped long or short begin to close their trades when price comes back to that zone because all they're concerned about is breaking even and not losing any money. All they want to do is not lose a lot of money and break even. I don't care if I can even profit right now. I just want to keep my $500. And when they close their trades out, you have buyers, other people, for example, all of you here, you're all hopping into whatever the buyer, sell, or whatnot may be on the move up or move down. So what does that do? It creates liquidity in the market. So now when that happens, the banks are now able to sneak their trade into the market without y'all noticing. So that's why, like I said, when price moves out of these zones, that's why price always moves out of these zones when it returns. Keep in mind, that's very key, is that the bank sneaks their trades into the market in supply and demand zones. That's why I call supply and demand zones smart money. It's where smart money builds up. We are retail traders by default, but you do not have to trade like one. That's why this training is called How to Trade Like Institutions, How to Become an Institutional Trader. Put your trades in with their trades. They trade with the most volume. They have the ability to push the market 100, 200, whatever plus pips. You don't. You don't have that kind of account stock. I don't care how much money you may have. You're not the entry bank. This market's been around since the 1800s. You do not have that kind of a volume. I'm sorry. But keep this psychology in mind. This is why supply and demand works, guys, because that's the psychology behind it for those trapped traders that the banks take advantage of day in and day out. They do this every day and they take money from the retail trader. Become the bank. And now you can start taking money from other retail traders. All right, so how do we draw supply and demand zones? We know how to spot them now, but how do you draw them? Because you want to know how to appropriately draw them, because why? Well, when you draw them, you're able to know exactly, okay, when price comes back to this area, I know what I'm getting ready to do. If you draw them wrong, chances are you're probably going to enter wrong and it's going to cost you big. So let's go ahead and look at how you draw these. It's really simple. It's really not that hard. Okay. So first, what you're going to do, we're going to go ahead and look at how you draw supply zones. First things first, you got to go grab that rectangle tool from your trading platform. I don't care what trading platform you use. MT4, Thinkorswim, TradingView, Investing.com, blah, 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 whatever. But you want to go ahead and you want to grab that trading tool. I'm sorry, yeah, that tool, that rectangle tool. You want to draw the rectangle for your supply zones from the open of the last bullish candle before the drop, which created the supply zone. Then you're going to drag the rectangle up to the most recent high before the drop. Lastly, you want to go ahead and expand the rectangle all the way over to the right so that when price buys back up to that area, you'll be ready to pull the trigger for your sell entry. Again, to draw a supply zone, you draw the rectangle from the open of the last bullish candle before the drop, which created a supply zone. Simply then, you drag the rectangle up to the most recent high before the drop. Last thing you do, expand the rectangle by dragging it all the way over to the right so that when price buys back up to that supply zone, you're now ready to pull the trigger for your sale. Of course, it will be the inverse for demand zones. So for a demand zone, you grab that same rectangle tool, but this time, draw the rectangle from the open of the most recent bearish candle found immediately before the up move, creating the zone. Then drag the rectangle down to the most recent low nearest the zone. Lastly, expand that rectangle all the way to the right so that when price sells back down to this area, you're ready to pull the trigger on your buy order. Again, for your buy zones, draw the rectangle from the open of the last most recent bearish candle found immediately before the move up, creating the zone. Then drag the rectangle down to the most recent low nearest the zone. And lastly, expand that rectangle all the way to the right so that when price sells back down to this area, you will be ready to pull the trigger and make that money. All right, guys. So this has been a big synopsis of supply and demand. I'm going to be doing more free weekly trainings on supply and demand. If you follow my signals channel and Telegram, what I tend to do sometimes is when I put a signal out there, I later do a training on it later on that week or that day or what have you to give people insight on how I came up with that signal. I find that that helps traders to, because I always, when I first started trading, I always told people, do not rely on signals. Hell, don't even take my signals unless it makes sense to you. If you can't see, but if I say sell euro pound and you can't see it selling euro pound, then don't sell it. You know, so, but I tend to do that sometimes. If I put a signal out there, I will then do a training later that day sometimes to explain how I came up with that signal entry, stop loss, and take profit area. But nonetheless, I'm going to close out with this video. This video I recorded, it's a small 3-minute video, 2-minute video. I recorded within my first month or second month trading Forex. I've been trading now since November 2015. And I made this video, I want to say either in December or January. But I'll go ahead and just close it out before I play the video. Again, guys, keep in mind, the world is built upon the principles of supply and demand. Buy low, sell high. Simple economics, simple economics. So if you want to become an institutional trader and trade with the volume of the intraday, you're going to have to stop some things and change some things. You're going to have to think, act, analyze, and trade the market just like the banks. You're going to have to stop trading against the intrabank and trade with it instead. Okay? All right. So here's a video. You all go ahead, listen to this, and we'll go ahead and close out tonight's live broadcast.
So much money to be made in these markets. Like literally, your trade skill and never have to work for nobody ever again. Like the key to winning in these markets is to learn what the banks are doing and trade. We say like beat the market maker, like fuck the market maker, like do what the interbank is doing, do who this was built for. You know, when you trade with the banks and you trade with them, you make the most money because you're trading with them and they trade with the most volume. No one strategy out of the millionaire out there is going to make you a millionaire. The main strategy is learn what the banks are doing, trade with the banks. That's money. At the end of the day, everything in life is built upon supply and demand. So think about those two words, supply and demand.
There you have it. Think about those two words, guys, supply and demand. Simple economic principles that our world revolves around. That everything that we do in consumerism, all of our consumer spending is built upon supply and demand. If you have not yet realized that in life, something's wrong. Realize it in life and use it in your trading. It's going to take your trading to a whole nother level. As I always tell anybody who's looking for mentorship in Forex, and they always tell me, what should I look for in a mentor? There's a few things. I mean, for one, personally, what are you looking for in a mentor? But more importantly, for a Forex mentor, if that mentor cannot spot the smart money in the market for you, you are wasting money on that mentor. If they can't tell you where the smart money, where the banks have their orders stacking up so that you can get into that trade right along with the banks to move that volume, to move in that volume, to take that 200 pip ride with the banks, then you're wasting money on that mentor. They're taking your money. So again, guys, I appreciate you guys joining tonight. Again, I do apologize for everybody who is watching live, who are live with me on the actual Zoom webinar right now, watching live, who have been here for the past, what, hour and 21 minutes, who for the first 30 or so minutes watched a bunch of slides without any voiceover. I do apologize. I had no idea the whole time that I was on mute. Like I said, when you try something new, sometimes everything doesn't go out. The best laid plans of mice and men often go awry. So I had everything set up right, broadcasting live on all 3 channels: Facebook, YouTube, the website, and everything. But the one thing I forgot to do on my Zoom webinar was just simply hit my unmute button. So I appreciate you guys who stayed with me this whole time and went back to the training along with me as I was able to break down the slides for you. I do appreciate that. Next time when we meet next week, we will not have any technical difficulties because now I know how to work all these systems in order to broadcast live with no problem. So it's been a pleasure training you guys tonight. I love this. I love what I do. I love Forex. I love trading. I love teaching. I love mentoring people how to do this. So keep in touch with me. Contact me. This video should be up for the next 4 hours. It's also being recorded. So after it comes down, after those 4 hours has passed, I will go ahead and this video will be made available on the economycreators.com website under the live broadcast page. It will also be made available on the Economy Creators business page on Facebook, and it will also be made available on the Economy Creators YouTube channel. So feel free to tune back in if you need reiteration of this training, or you just simply want to go over the information again for your own knowledge. I advise that you do because it is very beneficial to you going forward as an institutional trader. But for now, this is the Economy Creators signing off, and you all have a great weekend. Enjoy yourselves. Be safe out there. Don't do anything I wouldn't do. And everybody take care. And I'll talk to you soon.